Welcome back to the deep dive. Today we're going to cut right through the usual noise and look directly at the Q2 FY26 results for FSN E-Commerce Ventures, or Nykaa.
Right. We've got the official investor presentation, the press release, both dated November 7, 2025. So fresh data.
Yeah, and the numbers are, well, they're big, but more than that, they seem to signal something strategic. So our goal here is to figure out how they pulled off this balancing act, strong growth and faster profits across all their different businesses. Okay, let's unpack this.
Well, the first thing that hits you is just the scale and maybe the shock of how quickly profits jumped. Consolidated GMV gross merchandise value hit 4,744 crore.
And a crore is 10 million rupees, right? So that's huge, up 30% year over year.
Exactly, 30%. And revenue kept pace, up 25% to 2,346 crore.
But the figure that probably jumped out at you, the one everyone's talking about, is the bottom line. Net profit after tax, PTA. It just exploded.
Yeah, soared, 154% year over year, hit 33 crore.
Wow. And that 30% GMV growth you mentioned, that's important context too, isn't it? The sources say it's the best YoY growth they've had in, 6 quarters?
That's right, 6 quarters. So they're keeping the growth engine running, but now, finally, it looks like they're converting that into, serious profit jumps.
Okay, so that 154% pay T jump, it's massive. When you dig into the report, what's the key operational thing that explains that huge acceleration? Is there one thing?
I think it's really the operational leverage finally showing up strongly. And it's not just the PAT. Look at EBITDA earnings before interest, taxes, depreciation, amortization. That's their core operating profit.
Right.
That grew 53% year over year, hitting 159 crore. And critically, that pushed their EBITDA margin up quite a bit.
From what to what?
From 5.5% last year, up to 6.8% this quarter, Q2 FY26. And they explicitly call that out. 6.8% is the highest EBITDA margin they've reported since their IPO.
Highest since IPO.
Okay.
And they also seem to be getting much better at just managing the products they sell, the margins on those.
Exactly. Gross profit was up 28% YoY. That's 1,054 crore. And that resulted in a 44.9% gross margin.
44.9%. That's...
Yeah, highest in 12 quarters. So 3 years. It signals they're either getting better deals, sourcing better, or, more likely, there's a powerful shift towards selling stuff with inherently higher margins.
Okay, if we connect this to the bigger picture, it does raise a question, right? How did they manage to boost margins like that while they're still spending heavily on, physical stores and new tech? Seems counterintuitive.
It does a bit, but the answer seems to be efficiency. The sources really hammer this point big improvements in capital efficiency. Their ROCE, return on capital employed, for the first half of this fiscal year is now 14.1%.
And that's up from...
Up significantly from 11.3% last year.
Okay, so they're getting more profit back for every rupee invested.
Precisely. And maybe the clearest sign of that efficiency boost is in the cash cycle.
Ah, working capital.
Exactly. Working capital days, basically how fast they turn inventory and receivables into cash, dropped to just 31 days.
31 days. That's pretty quick for retail, isn't it?
It's very quick. It probably means they're turning over inventory faster, maybe getting better payment terms from suppliers. Whatever it is, they're getting cash out of their operations much faster, which is vital when you're growing like this.
Right. So we just saw gross margin hit a 12-quarter high, almost 45%. That kind of jump usually means they're selling more expensive things, more premium stuff.
Which leads us right into the core engine, beauty, still the biggest piece of the pie. GMV there grew 28% YoY to 3,551 crore this quarter.
Still strong growth.
Definitely. And the report links that growth specifically to 2 main things: reaching more customers and really leaning into premiumization.
Right. Reach first.
Their total beauty customer base is now 40 million. That's up a huge 31% year over year. Massive reach.
40 million customers. Wow. And the premiumization part.
That seems key to the margin story. They're really cementing their place as the go-to platform for global luxury brands wanting to enter India.
Yeah, I saw the list. This quarter alone, they added Prada Beauty, Maison Margiela, and got exclusives for La Prairie and IT Cosmetics. These aren't small names.
Not at all. They're locking in that high-spending customer right from the start. And they're smart about trends, too. Take K-beauty.
Huge trend.
Massive. And Nykaa clearly leads it in India. Largest selection, they say, and over 60% year-over-year GMV growth just in K-beauty. They keep adding brands, too, like Arencia and Torden this quarter. They own that gateway.
Okay, but let's circle back to the stores. You mentioned efficiency earlier. They added 19 new physical stores this quarter, now 265 total. For a company boasting about capital returns, isn't that a bit well, expensive. How do they explain spending on all these stores?
That's a fair point, and the sources address it directly. They frame the stores as high-margin transaction points, not just billboards. The payoff seems immediate.
How so?
They state that two-thirds of the GMV generated in the stores comes from premium brands. So the stores aren't just general outlets. They're specifically targeting and serving that high-value luxury customer who often prefers to buy in person. It looks like strategic spending, not just blind expansion.
Got it. So the stores feed the premium strategy, and the tech side supports it too, right? Like Nykaa now.
Yeah, the rapid delivery. 60 to 120 minutes in 7 cities now. They've done over 2 million orders that way. That kind of speed is a serious operational advantage, hard for others to just copy.
And they're using tech in-app as well.
Right. They mentioned the AI skin analyzer tool and this personalized beauty portfolio thing. It uses AI, apparently analyzing millions of customer data points to suggest products. This sounds like it's driving up conversion rates and getting people to buy across more categories. Pretty smart integration.
Okay, so this focus on higher margins, premium products, efficiency, it all leads perfectly into what I think is maybe their most powerful weapon now, the House of Nykaa.
Their own brands portfolio. Yeah, it's becoming a beast. Across both beauty and fashion, it hit an annualized GMV run rate of around 2,900 crore.
Annualized run rate, so projecting forward, and the growth.
Robust. 54% year-over-year growth for the whole House of Nykaa portfolio. These own brands are clearly becoming core strategic assets.
Especially in beauty.
Absolutely. The beauty brands within the House of Nykaa, they clocked 627 crore GMV just this quarter. That's up an incredible 74% year-over-year.
74%.
Yeah. Makes them, according to the report, India's second largest homegrown beauty brands portfolio. They control everything. The margins, the distribution, the story.
And Dot & Key is the star, right?
Phenomenal story there. It's now running at an annualized GMV of over 1,500 crore.
Wow, that's more than half the entire House of Nykaa run rate just from one brand.
Pretty much.
Yep.
And it grew over 110% year-over-year. Plus, it's operating at a high teens EBITDA margin, very profitable. And it's not just succeeding on Nykaa's own platform. They mention it's a leader in things like lip balm and sunscreen on other major online marketplaces, too.
Okay, and then there's K-Beauty. The numbers look solid, annualized GMV run rate over 350 crore. But the really interesting bit is the international move, isn't it?
That's where it gets really interesting, yeah. The debut in Space NK in the UK. That's a major premium beauty retailer.
And how did it do?
Apparently extremely well. K-Beauty became the #1 search term on the Space NK website shortly after launch. And it ranked in the top 5 brands overall in several of their physical stores.
That's huge validation. It proves these brands they built internally actually have legs internationally, real global appeal.
Exactly. It's a big proof point for the whole owned brand strategy.
Okay, shifting gears slightly from beauty. Let's talk diversification. Fashion. It seems to be recovering.
Showing serious signs of recovery, yes. GMV grew 37% year-over-year to 11,180 crore. That's strong growth, driven partly by adding big new brands like GAP, Guess, and even H&M Fashion making its debut.
But we need some balance here, right? It's growing, but is it profitable yet?
That's the critical point. The EBITDA margin improved dramatically. It went from negative 9.0% last year to negative 3.5% this quarter. So a big improvement, narrowing the losses significantly. But you're right, it's crucial for you listening to remember. Fashion is still losing money overall. It's a drag on total profitability. The turnaround looks promising, shows they're focusing operations, but it's not fixed yet.
Right, work in progress.
Yeah.
And we also saw some early moves on global expansion with Nykaa. That's their venture in the Middle East, the GCC.
Yeah, early days there. 5 stores open now in the UAE and Oman. E-commerce GMV grew 38% just quarter on quarter, so decent initial traction. Focus seems to be prestige beauty and K-beauty again.
Okay, final segment. Let's talk about something that maybe doesn't get as much attention but seems structurally really important. Their B2B network, Superstore.
Right. Superstore by Nykaa. It often flies under the radar, but the scale they've built is, well, kind of staggering.
How big is it now?
They claim it's India's largest B2B beauty distribution network, reaching over 3.3 lakh. That's 330,000 retailers.
330,000 shops.
Across more than 1,100 cities. And they built this in just 4 years. Reaching that many retailers means Nykaa's physical reach extends into almost every corner of the Indian beauty market. That's a huge competitive moat.
And it's not just about reach, is it? It's becoming profitable, too.
Increasingly so. The profitability numbers here are quite striking. Gross margin in Superstore is up 134 basis points year over year.
Okay, 1.34 percentage points.
And the EBITDA margin, up 422 basis points year over year.
Whoa, 4.22 percentage points improvement in operating margin in just 1 year. That's enormous for a distribution business.
It is, and the sources are pretty clear on why this is happening.
Let me guess. House of Nykaa
And
brands.
bingo. The report directly links this big margin jump to one main factor: a 5 times increase year over year in the share of their own House of Nykaa brands being sold through the Superstore network.
Ah, the feedback loop.
It's the ultimate feedback loop. The B2B channel isn't just a passive distributor anymore. It's an active, high-efficiency pipeline pushing their own highest margin products deep into Tier 2 and Tier 3 cities. They essentially guarantee shelf space and distribution for their own brands.
So it connects their internal brand engine directly to boosting efficiency and reach across the whole country. Very smart.
It locks in domestic dominance in a really powerful way.
So what does this all mean? When you put all these pieces together, the profit jump, the premium push, the own brands, the tech, the B2B network.
I think it signifies a really successful strategic pivot.
Hmm.
Those long-term investments they made in stores, in tech, and crucially in building that house of brands, they're not just future promises anymore. They're translating right now into faster, scalable profits.
Right. The narrative feels like it's shifting from just growth at all costs to something more like profitable ecosystem control.
Yeah, ecosystem domination feels about right. Which leaves us with a final thought for you, the listener, to chew on.
Okay, hit us with it.
Given how dramatically successful the house of Nykaa brands like Dot & Key and K-Beauty are becoming, and seeing how vital they are for driving B2B profits and even starting international expansion, what are the real limits here? How far can this owned brand ecosystem approach go?
And maybe, how quickly does that owned brands division become strategically even more important than the original marketplace itself?
Exactly. That internal dynamic owned brands versus marketplace, that's definitely the thing to watch over the next few quarters.